Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. Let's take a look at the week ahead for the week starting Monday, the 8th of April. Coming off the back of a week that saw big volatility at the back end of the week, most notably with that surge in oil prices and commentary from the FOMC members leading into a jobs report that saw strong payrolls once again and continued concerns around average earnings. Inflation really remains a problem, and that will be a key theme for the week ahead, because as we see here with some of the highlights, the top tier events of the week, inflation remains a main part of that, with US inflation coming on Wednesday. So aside from that, Wednesday, we also saw the RBNZ rate decision taking shape. We've also got the Bank of Canada rate decision, the FOMC minutes. So Wednesday's the big ticket day, but we also see that followed up on Thursday with the ECB rate decision. We've also got that OPEC monthly report coming out. We've got Chinese inflation. And then on Friday, we've got Chinese trade data, which will also be very notable leading into the UK GDP release. In terms of the first area I wanted to focus on, it's the US. No surprises there. Of course, we've got the inflation gauge coming out, and certainly the fact that we're seeing energy prices moving towards the upside really does point towards a significant risk that we don't see US inflation move back down to target in the coming months. And certainly that really is likely to temper expectations around the possible rate cut that markets appear to be thinking could come in June. That seems highly unlikely now. And certainly, I think this is probably going to be a reminder of that. If you look at the expectations are for inflation to increase this time around. So that could really highlight, if you look back at my previous videos where I'm sort of deep diving into the inflation metrics, the US inflation metric always looked the most difficult out of, say, the Bank of England, the ECB, and the Fed. It looked the most difficult to get back down to target and the most unlikely. And when people are talking about this June rate cut, that, in my mind, as I've said for many months now, was going to have to happen with inflation well above target. And this really highlights that, right? If people are expecting to see the Fed cut rates in a couple of months' time, well, it could be a stark reminder if they see inflation moving upwards on the headline basis anyway. In terms of the core reading, 3.7 expected. But again, still way away from target. It's not like they're in the twos at the moment. And so this could be a stark reminder. And as if, that isn't enough, probably going to be reminded of that with the FOMC minutes coming on later on that day. Elsewhere, we've got PPI, so sort of factory and input price inflation data coming on Thursday, the jobless claims, of course, the Michigan consumer sentiment number coming out as well. So a whole host of key data points there. I just wanted to bring up the dollar index. Let's just bring that up here. There we go, and get it full screen. So here's the dollar index. What we have seen around this recent jobs report over in the US is this latest push towards the upside. And it really does sort of align with this wider move that we have here. Let's see, that kind of lines up to an extent. What we're looking at here is this sort of pullback with this latest surge pointing towards the potential for another rebound for this market. Now, part of the difficulty with sort of trend following is really determining where your key swing highs, swing lows, and key levels of note should be. On this occasion, you could say, well, look, we've broken back down through this low here. But you can see that this move lower here and the breakdown through this support level here looks very similar to exactly what's happened here and this pullback into the wider move. So this is a prime example of the fact that there are essentially trends within trends. So you can see here this sort of shorter term trend coming up here. And then at some point we pull back into the wider retracement and come back into this wider trajectory. Well, we've come back into that retracement. We've come back into that trajectory. And now we're pushing higher once again. Let's just get the fib drawn on here. Let's see, is that 61.8? There you go. Absolutely perfectly. So we've pulled into a 61.8 and we're starting to head higher once again. I think this inflation gauge is going to be a stark reminder. If markets don't know at the moment, they will by the end of next week, that a June rate cut is highly unlikely, and the FOMC minutes are probably going to be a reminder of that as well. So I wouldn't be surprised to see US dollar strength come in this week. And inflation, look, what's got to happen for the US dollar to sell off and everyone suddenly feels confident around the idea that we're going to see rate cuts coming in the near future? Well, who knows, really? I mean, because ultimately, if you look at the monthly metric, let's just switch back to this. If you look at the monthly metric, it's forecast to actually decline, right? 0.3% expected here. So it's not like we're expecting a big monthly reading and that's what's pushing up the year on year. It's these baseline effects. And as you'll see on my breakdown show that will also be on our YouTube channel, this ultimately is a month where it's going to be very difficult to drive it down because we're not necessarily replacing a massive historical figure. And so despite the fact that we've got, a decent number at 0.3 coming in, we're still expecting to see that year-on-year figure move towards the upside. And that could be a stark reminder to markets that we need to be more patient, and that should be beneficial for the US dollar. Certainly the jobs report has set us up for that. So I wouldn't be surprised to see further US dollar strength going forward. Next, we'll look at what's happening in Europe. Now, we've got some trade data coming out of Germany earlier in the week, but the big event, of course, is going to be on Thursday with the rate decision from the ECB. Now, markets are not expecting a rate cut, but the key thing is that we are expecting a rate cut in the near future. That comes in June, according to market expectations. This is from the London Stock Exchange Group. You can see here the April rate decision. 90% expectation that we keep rates steady. And I would say what's happened in energy prices is going to be a key factor of that, because that number has actually grown recently. So despite the fact that inflation is moving back down towards target, albeit at a perhaps a slower pace than we thought, because we saw a fairly chunky monthly reading, that still does put us on track to break back down to that 2% target in the near term, I reckon. So this looks about right in my mind. I think we will get that June rate cut, but really, if we see a big resurgence in terms of oil prices, maybe that's the kind of thing that makes them hold off. But the key thing here is going to be that markets are looking for direction. Markets are looking for confirmation that the ECB are planning to cut rates in June. And so look out for commentary that comes alongside this, that the key event is probably not going to be whether they cut rates or not, because it seems very unlikely. Instead, the key event is probably more likely to be whether they guide markets in the direction of a rate cut next time around. In terms of the market I wanted to look out for here, I thought I'd bring up the DAX. Now, we've seen a pretty significant sell-off of late, and that has brought us back down in towards the 76.4 fib, which is at 180.60. But as you can see here, it has sort of taken the shape of an ABC style retracement. I would say that from a wider perspective, there is a risk to equity markets as a whole, given what we're seeing in terms of the inflation rate coming out from the US. So if we see big risk off moves around that, then of course that's going to have implications for not just US markets. As we've seen with the payrolls release, of course, this market's moving sharply lower. But if you look beyond that inflation report, which is happening earlier in the week, compared to this ECB decision, that ECB decision has the potential to lift sentiment. So if we potentially see some risk off sentiment coming into play around that inflation report for the US, look out for this ECB decision to potentially turn things around and provide a more optimistic outlook going forward. That key support level that we have here is essentially 179.100. If we stay above that level, that's really going to give me greater confidence that we do continue on this upward trajectory that has been very impressive of late. But you can see here, this pullback that we've seen at the moment potentially moves us into a sort of consolidation move, with the bottom possibly coming around any possible sell-off around that US inflation report before the ECB potentially step in with a little bit more of an upbeat tone in terms of the possibility of a rate cut from them in June. But again, I don't expect to see a rate cut at this meeting. And then finally, I wanted to touch on the Bank of Canada. So this got me a little bit confused, but I've thrown on some of the US US energy data stuff as well, because we do have that correlation between energy markets and the Canadian dollar. So keep an eye out for any further advancements. Now, ultimately, there are, the gains that we have been seeing are more around Middle Eastern concerns, the potential breakdown in relations between Israel and Iran, and the possibility of a conflict between the two. Certainly, if that happens, you're looking at the possibility of significant upside for oil prices. But nonetheless, markets will be really looking towards that Wednesday interest rate decision from the Bank of Canada as a key determinant of sentiment for the Canadian dollar going forward. The question mark is whether they feel like they need to wait around for their neighbor, because I think we're going to have to see caution from the Federal Reserve. The question mark is whether we see the same kind of caution from the Bank of Canada. Markets don't necessarily expect that, but there is a strong chance that we still see rates on hold even in June, 33% chance of that. We do see, or markets do see, a higher chance of a rate cut from the Bank of Canada this time around compared to the ECB. The ECB was 10% chance. Here we've got 23% chance. So if they do move ahead of all the others, bar the SMB, then that could, of course, have significant implications for the currency. So let's look at dollar CAD. We can see here that we've seen this nice pop with the continuation of this bullish trend coming into the fore. Near-term downside over recent months, or certainly throughout 2024, has always provided us with buying opportunities for this market. And essentially, if we were to see the Bank of Canada cut rates ahead of time, so if we saw them cut rates at this meeting, or they allude to a very high chance of a rate cut in June, and then that improves the numbers for expectations for a June rate cut, then you're likely to see this market move towards the upside once again. I mean, I think we've got the basis of a potential breakout from this pattern anyway, just in terms of, it has been very slight, this trend on the top end. So, the question mark is, are we going to see a very minimal rally? I think there's a good chance that we sort of push beyond that. I think the US dollar strength story could play out over the course of the week with, or certainly the beginning part of the week, with the whole US inflation number coming out. And then we've got the Bank of Canada, which there's a good chance that if they don't cut rates, which again, 23% chance, there's a good chance they lay the groundwork for them to cut rates in June. And again, that could provide upside for this pair. So keep an eye out for dollar CAD with a break back all the way back below this recent swing low. I say all the way. We saw it just over a day ago, 134.778. As long as we remain above that level, then it looks bullish. But if we see pullbacks, we'd need to see a break through that support level to negate this bullish trend that has been playing out over 2024 thus far.